Hello and welcome back to goldstocktrades.com. This is Jeb Hanwerger, and today's Wednesday, June 19th, 2013. It's about 9:30 in the morning, and I wanted to give you an update on today's markets. We're all waiting for the Federal Reserve announcement that will be coming out this afternoon. There's concerns about if the Fed will indicate some sort of exit from quantitative easing. There's also rising concerns of a transition at the Federal Reserve, with Bernanke leaving later this year. The real concern in the marketplace will be this exit of QE. This can take we don't know what the consequences of how this exit will be on the markets. There is rising concerns in several markets that I've seen over the past few weeks that I wanted to address in this update and what the market may be telling us. So the first thing that I want to look at and draw your attention to is the bond market, the fixed income market. Since 2012, we begin to see the 30-year bond reach a top above 150, and the 10-year note hit a top. And we've been slowly seeing capital moving out of fixed income in a search for yield, higher yield. It went to junk investment-grade bonds, then to junk bonds, then to the dividend players. So we've been seeing bonds in the search for yield, capital going from bonds to the equities, especially the large cap dividend paying equities. And you have to remember there's been $85 billion a month going into the banking and housing industry and to keep the bonds low, yet we're seeing the bonds declining even with all this capital that's being infused into the market. So what will happen when things taper? We have to keep a close eye on those 10-year and 30-year bonds. If it breaks below, 135, 128, 129, there's been some support there. But, this is what the Fed has to decide and think about. If we start seeing out of bonds, and if we start seeing that the mortgage-backed securities begin declining, and the bonds been declining, and the banks are going to have some serious issues. So keep a close eye on those 30-year bond, 10-year note. We've been seeing money coming out of bonds, out of precious metals, and into the search for yield. Remember, gold and silver do not provide cash flow, and that's what investors are popular today. They're looking for these bonds, for these dividend-paying equities, and there's been a major rally since 2011 in the Dow that went from 12,000 to 15,500. S&P went from below 1,300 to close to 1675. The NASDAQ hit from a low from 2,500. It's almost at the 3,000 level. The Russell 2000 went from 750 to 1,000. And the Nikkei, they've been devaluing yen like crazy at a faster rate than the U.S. recently from this new Abe government. The Nikkei went from, after this election, from 9,000 to close to 16,000. That was a 70% gain in less than 6 months, and this was all from this devaluing money. And we're beginning to see signs. The important point here is that we're beginning to see signs of a rotation into energy right now. Crude oil broke the critical $98 mark. It's on the verge of breaking the $100 mark. That could be pretty significant, as we could probably see a move up to the 110 area and a potential rise in in energy prices, which is a signal of inflation. Natural gas, we've already been seeing that. I mean, that's been positively correlated. It's one of the few commodities that's been positively correlated with and has gone up along with equities. Natural gas went from 2 to 4. It actually outpaced the natural gas is the one commodity that outpaced equities and the Nikkei over the past year. So that's more than a double. So we're seeing a rise in energy prices. Countries are paying more for natural gas outside of the U.S. than the U.S. Significantly. So keep a close eye on energy prices. Gold and silver are reaching major support areas. And I know that gold and silver is not popular today amongst the media, and it's called a broken commodity by some, or that the trend has been broken. Gold has actually held up pretty strongly after such a remarkable move from $800 to $1,800 from the 2009 low to the top in September of 2011. And there are corrections do occur. We've pulled back to the 5-year trailing moving average and are holding it. It looks like there's potential trend support here for gold. So that we believe we could see a reversal, a positive reversal for gold if we begin to see more of this rotation into commodities. Silver, it's interesting because silver's pulled back to the low 20 area, which is really the platform where it broke out in 2010 when QE2 was announced. So there's strong support here for silver, and it seems like the consensus opinion is saying that this tapering is going to hurt precious metals. But in my personal view, precious metals, when interest rates do begin rising and all this money is going to be coming out of bonds, they may not want to go into the overvalued equities. They may want to protect themselves from this decline in the dollar. One of the best ways of looking as a hedge against inflation and currency risk is gold and silver. So we may see a positive reversal at these levels. We saw it a few weeks ago, about 4 weeks ago, in gold and silver on the daily charts. We didn't really yet see that in the weekly charts, and I'd like to be able to see that and be able to signal a weekly reversal. And who knows, we may get that this week. Out of the metals, the only metal that really isn't a significant uptrend that's positively correlated with the equity market is palladium. And it has had a series of higher lows. It rallied from the 575 area to 775. So keep a close eye on palladium, where supply is very constrained. Platinum and palladium supply is very constrained from South Africa right now. So we should keep a close eye on the platinum and palladium market. And last but not least, the U.S. dollar appears to have made a false breakout at that 84 area. It broke out actually into on the weekly chart to 84 through 84, and then declined significantly below the 82 area, which was a level of support. And we're keeping a close eye if it breaks below the 79 area, because that could be a potential double top and a false breakout and a bull trap. And we may be that may have been the dollar may have attracted some investors' money exactly at the wrong time, as it broke out and then reversed very strongly to the downside. So that should support gold and silver, which is at critical trend areas and 5-year trailing moving averages. And we may see that all this fear of tapering, which investors think will be bad for gold and silver and commodities, may actually be a signal of that our economy is expanding and we're going from a deflationary period to an inflationary phase, and that should set the stage for a rebound in the commodities and the precious metals and the undervalued mining stocks. So stay tuned. We will be closely following the Fed decision later today, and we will keep you posted. Thank you.